Most people never bother to look at the long-term charts. Well, most traders are caught up in the day-to-day action, but I think it's important to at least once a week to look at the long-term charts and uh, and get some idea of you know the forest from the trees, so to speak. So I'll start off with the S&P. You can see, at the top last year and early last year, and then in the fall of last year, price was just stretched too far above this long-term 200-week moving average. We had two options. Either the bull market comes to an end with a parabolic move far to the upside that then crashes and moves, way below the um, 200-week moving average, similar to what happened here in the last two bear markets, or we have to enter a consolidation phase for a year or two and allow this average some time to catch up to price. And clearly that's what's happening. This is not a triple top. The bull market is not coming to an end. We haven't had our bubble phase yet by any means, and we aren't in an irrational period like we were here, where people were pricing, especially tech stocks, to absurd levels, or here where they were pricing housing at absurd levels. That's not happening now. Companies, are making good profits. We're just in a consolidation phase after a powerful run up from the elections, and we're giving this moving average some time to catch up to price. All right, moving on to the leading tech sector. Same thing's happening here. Um, the Nasdaq got to 8,000, and at that point, one of two things had to happen. We either begin a parabolic move similar to what happened here, and just really get absurdly stretched above the long-term moving average, which then, of course, the bubble pops and you have a collapse and a very long-term bear market, or the market has to enter a sideways consolidation phase for a couple of years and allow the moving average some time to catch up. And I'm about 99% sure that's what's happening. Is we've just um, gone a long ways in a short period of time, and now we're going to have to deal with a sideways market for a couple of years. So pretty sure we've started an intermediate degree correction. I would really like to see the NASDAQ at least come down to 7,500, and 7,000 would be more realistic in my opinion. Something that gets a little closer to this 200-week moving average, generates some extreme bearish sentiment, getting more and more people on the bear market bandwagon. Basically, we need to get a lot more people on the wrong side of the market, and then at that point, we'll be ready to break out and start another leg higher. But right now, probably still too stretched above this long-term moving average to have really much chance of a sustained breakout above this 8,000 level and a run to 10,000. 10,000 is definitely in the cards. 10,000 is going to be a piece of cake. I imagine before this bull market's over, 20,000 is going to be a piece of cake, but we're not ready yet. We need to go sideways a little longer, give this moving average some time to catch up to price, and then we can get a sustained breakout above this 8,000 level and produce the next leg up to 10,000. That's probably going to be next year. I doubt that we're going to get a sustained breakout this year. All right, moving on to the semiconductor index. This is the leading index. This is being driven by the integration of artificial intelligence into human society. You can see the top, the bubble top back here in 2000. We had this very long um, consolidation, come back up, test this level, um, get our first real attempt at a breakout. But like I have been saying, I think it's still too early for this to be a sustained breakout. I think we're going to have to come back and test this level, and that's exactly what we're doing. We're back here at 1400. I would like to see the semis come down and test, at least the 1300 to 1350. That's about where we were at here. About I think 1360 was the 2000 high. I'd like to see the semis at least come back down and retest this zone during this intermediate decline. And if we could get some kind of a really scary crash event over the next 2 or 3 weeks, maybe something that even comes back down to test this 1200 level, that would be even better. Uh, a little bit closer pull back to this moving average. You can see again, we're just getting stretched way too far above this long-term moving average. We need we need to go sideways a little longer, give this some more time to catch up to price, and then I think we'll be ready for a sustained breakout above this level, one that doesn't um, look, doesn't need to come back and retest anymore like this one was destined to. On the other hand, the CRB, I think it made a generational low right here in 2016 at this 3-year cycle low. The jury is still out, but I think this is going to turn out to be a 3-year cycle low right here, the end of last year. Um, and you can see commodities are in the process of trying to recover this 200-week moving average. So uh, the exact opposite is in play with commodities. They just got stretched way too far below the moving long-term moving averages, and now they're churning sideways, uh, allowing this moving average time to catch up to price. And I suspect where the commodities are getting ready to uh, break out above this moving average and start the moving average uh, moving back up in another long-term bull market. You can see the last bull market ended way back here in the middle of 2008. I think um, I think we probably started another bull market in 2016, but we've been in a long basing phase for the last 3 years, and maybe we're finally ready to get back above this 200-week moving average and start the average turning back up, similar to how we started to turn the average back up here in 2002. And you can see why I say I think this is a generational low. The 2016 low dropped considerably below the 99 and 2001 double bottom here. So I think this is a generational low that's we're not going to see again probably in our lifetime. Gold, on the other hand, has been much, much stronger than the general commodity markets. The generational low, I think, for gold back in 2015, you can see, was nowhere near testing this 99 and 2001 lows. So the entire metal complex has been much, much stronger than the commodity complex in general. And again, you can see, whereas the commodity markets still haven't really gotten above the 200-week moving average, gold, on the other hand, has not only recovered it, but the 200 is starting to flatten out, and if you look closely, it's actually starting to turn up. So I'm seeing a lot of people that are very negative on the metals, um, only expecting bad things to happen for the foreseeable future. And that's the sentiment that we always get at these intermediate degree corrections. But if you take a look at the longer term chart, it's pretty clear that this was uh, not only a bear market bottom, but I think probably a generational low for gold. And we've started a new bull market, but one that's just been kind of stuck in this basing phase as the 200-week moving average bottoms, flattens out, and now is just starting to turn back up. And then finally, the dollar. We're still seeing lots of dollar bulls, but if anybody that bothers to take a long-term historical look at the dollar, I mean, it's clear we've been in a bear market since '84. Very long-term secular bull market with 8-year counter trend rallies along the way. That's all this was as well. We are, not even close to threatening to take out the highs from back in 2000. And as you can see, The dollar has started to stagnate. It's not holding above the 200 week moving average like it has during these periods of secular bull market where the dollar has been rising. Uh, that period I think is over. I think it ended here in uh, early 2017, and I'm pretty sure the dollar started another bear market right here. And you can see it's struggling to even hold the 200-week moving average, much less uh, get above it and stay well above it, as is the case during these bull market moves here and here. So anyone that can pull up a long-term historical chart can see the fallacy of the uh, bullish sentiment in the dollar. That there is nothing in this long-term chart that is bullish on the dollar, and really not much bullish since the top in 2017. And I think that the dollar is pretty close to rolling over, and we're going to lose this 200-week moving average and probably lose it for good for many years to come here soon. And a bear market in the dollar should be beneficial to everything, and that's kind of been my theory, is that everything is going to rise together, kind of the same as what happened here from 2002 to 2008. Stocks, commodities, everything went up together, and I think that's what is in the works again. Uh, Once we get confirmation that the dollar has rolled over and is going to lose this 200-week moving average for good, then I don't see any reason why we won't have that same kind of correlation where everything goes up together: stocks, gold, oil, commodities in general. Basically just an inflationary phase, the same as we had here from 2002 to 2008. I think we're about to enter another inflationary phase.